All right, recording has started. So let me go ahead and share screen. I know some people are still coming in because of some health screenings, but then this video will be available for them to review in case they missed any portion of the class. So today we'll talk about dividend payout theory as the lecture title slide suggests. And dividend theory, on the one hand, might seem sort of indifferent for you. Like, well, what difference does it make how much of a dividend we pay? Because if the stockholders own the firm, right? And so when the firm has income, it basically divides that income into retained earnings, which stay within the firm, hence they are retained, and dividends, which are paid out to the owners of the firm, which are the shareholders. But the natural question is, well, if the owners of the firm still are entitled to that section of the firm that they own, how many ever shares they own, whatever percentage of the firm they own, then they're also entitled, they always have claim to those retained earnings that the firm keeps for itself. So what difference does it make if the firm issues those earnings out to the shareholders or keeps them inside the company? Because if it keeps them inside the company, that's okay because the shareholders still have a claim to it as a result of share ownership. And if it issues the dividends out, well, the shareholders now have the dividend just arrive in their brokerage account. And what difference does that really make? Well, we'll talk about several differences. And as one might expect, one of my favorite topics to discuss is taxation. And one of the reasons that it will be different is because of taxation. So the course outline, let's see if I can get it to move. We're going to talk about types of dividends and the way that they are paid out. We'll talk about some of the issues that managers face with respect to dividend issuing policy. There will be some difference between dividends issued in stock or dividends issued in cash. I don't have to issue a dividend in cash. I can give you more shares of the company's stock and thereby dilute the value of each share within the company. Once again, I'm just printing off shares, but it's still a way that you can compensate potential shareholders. And because they will receive shares that are proportional to their current ownership stake in the firm, they, at least the people that currently own the shares, will not be diluted. Sign into Skype. I don't want to do that. Okay. All right. And then we'll also talk about how managers view the dividend decision, because that's also important. You're going to see that there's sort of all these theoretical frameworks about how managers should view the dividend issuing decision. But then when we actually go and survey the managers, they kind of have their own reasons for doing what they do, which could be due to the asymmetry in information between us and the managers. It could also be because of an agency problem. The managers may not always want what is optimal for the firm. They might want what is optimal for themselves, or at the very least, they sort of want to enjoy the quiet life and not be disturbed by fluctuating their dividend policy too frequently. Now, before I kick off, I want you guys to know that this chapter, it's only 25 slides, which is great. I'm hoping I can get through all of the slides today so that on Thursday, we can have some of you guys present the financial calculations worksheet. Now, I know you guys have done the financial calculations worksheet, right? You two have done it, right? Yes. Yes, good answer. Okay, so you guys will be, if you want to, I'll first ask for volunteers to come up here and present. Have your flash drive ready so that you can plug it in either into this laptop or into this computer, right? The USB drive, and just have your financial calculation spreadsheet saved on that drive. And go ahead and make sure you do the calculation spreadsheet ahead of time. In the past, I've had some students come up and they just do it on the spot. No. I want you to do it ahead of time. I want you to make sure that all of the numbers work, that they look logical, that you don't have, let's say, negative mortgage payments or something like that, or your mortgage becomes a negative number after a certain point, or your loans, you sort of have this negative loan balance after you've satisfied a loan, and that negative loan balance then compounds at the loan interest rate. No, just go ahead and make sure that you cut it off after you've, paid off whatever loans you've got. Also, be able to articulate why you think your rate of return on stocks or bonds or any other investment vehicles is reasonable. Because I'll be looking at what rate you put in when you project your future earnings from your investment portfolio over the course of 20 or 30 years. And if your rate is like 50%, again, I'm not saying you can't earn that. There are hedge funds out there that earn that much, but unfortunately, that's not the average return for all of us. And so the question that I will ask you is, well, why do you think that rate is reasonable? How can you expect that rate over a long period of time? So just be sure you're ready for that. I wanted to make that announcement at the beginning of class. Okay, so this is going to be the chapter outline. I mean, you can kind of review it on your own terms. And so let's begin with dividends. So we've talked about dividends before, both in Fin 3310 and now in Fin 3311. So Introduction to Corporate Finance 1 and 2. I mean, they're clearly an important point of discussion just as a technical matter, because you should know that stocks, usually once every quarter, but sometimes for some stocks, once every year or once every 6 months, they declare and pay a dividend. Now, that's important because that's a cash flow into the bank account of the investors. And so these dividends, basically, they can be used by the investors however they want to. It's basically the company saying, we have some income this year, and we're going to partition that income. We're going to retain some of it in retained earnings, and the rest is yours to keep. There are different types of dividends. So regular dividends are dividends that are usually paid quarterly. And while companies can change dividend policy almost at any time, right? They can say, look, we've been paying a quarterly dividend and now we're going to terminate quarterly dividends. Or we haven't been paying any dividends, but now we'd like to initiate quarterly dividends, like Facebook did recently, and you saw the rise in its stock as a result. While that can happen, typically that doesn't happen with regular cash dividends. The CEOs, for their own reasons, as we'll discuss at the end of this chapter, they sort of like to keep dividend policy fairly consistent. Now, sometimes there are extra cash dividends, meaning that the company is issuing this money out. You shouldn't always expect it, but maybe they have some additional net income that they're able to divvy up and pass along to investors. There are special cash dividends, which are similar to extra dividends. We just call them something different, but the fact that it's a special cash dividend indicates that there won't be a follow-up. That's the only dividend basically that you're going to get. And then finally, there's the liquidating dividend. And so the liquidating dividend says, okay, it's been a profitable business. Let's say we run a typewriter company, okay, and then somebody comes out and invents the computer. And we see that our typewriter company is just not going to last. So instead of, going on until we begin to lose money and then have to file for bankruptcy, that's terribly expensive. We're just going to say, forget it. We had a good run here. We made a bunch of money. Congratulations, everybody. Let's shake hands, sell all of our buildings, all of our equipment, everything else, and just liquidate the firm. And so as the shareholder, you will be entitled to whatever your portion is of that liquidation. That'll be called the liquidating dividend. And then, your shares will just disappear from your brokerage because that company is no longer listed on the stock exchange, okay? Because it just disappeared. So there are some things you need to know about the dividend payment. They're important dates, and they're important dates because people trade around these dates. So first, there's the declaration date. This is when the board declares this is how much our firm is going to pay out. So it's not something the CEO can decide without board approval. The board ultimately is the final decision maker on dividends. And of course, the CEO can sit on the board and can make suggestions to the board, but ultimately it's by the vote of the board. And when the board declares a dividend, the firm now is liable for paying it out. That should seem sensible, right? You can't declare a dividend of 20 cents a share and then only pay out 10 cents a share or refuse to pay it out later. You basically have to pay it out unless some major calamity occurs. So then a firm begins to trade X dividend after a certain point. So there's the declaration date, and then some time passes, and then there's the X dividend date. Of course, you know what the X dividend date is going to be once the dividend is declared. What does it mean to trade X dividend? Well, basically, it means that this is 2 business days before the date of record. Okay. And so you have to hold the stock prior to the X dividend date to qualify for the dividend, right? Because you understand that there's kind of an issue here, right? It's not like a bank account where no matter, like when you hold your money in a bank account, the interest accrues, daily or weekly or so on. So the longer you hold the money, the interest rate, the yearly interest rate is subdivided into, let's say, daily portions, and your money accumulates interest in direct proportion to how long you've held the money in the bank. But that's not true with stock. Whether you've held the stock for 5 years or 5 days, so long as you hold that stock prior to the ex-dividend date, you will be entitled to the dividend. So in some sense, the person that's been holding you for 5 years is not really as rewarded as the person that just bought in right away, right? So you have to keep tabs if you want to be entitled to the dividend. You have to keep tabs of the ex-dividend date and buy the stock before this date. If you buy the stock on the date or after the date, you won't get the dividend. Okay? And so usually what happens on the ex-dividend date, because at that point you're no longer entitled to the dividend, is people go ahead, wait till they've passed the ex-dividend date, and then they sell the stock. So you can receive a dividend. Let me give you an example. Let's say the ex-dividend date is March 31st. Okay. So if you hold the stock on March 30th, all right, then let's say March 31st comes, you can go ahead and sell on March 31st. And even though you're no longer the owner of the stock, the dividend will deposit into your bank account sometime in April. Okay. Conversely, you can be somebody that doesn't own the stock. You can buy into the stock on March 31st, but because it's traded ex-dividend, when the money is divvied out from the company, the money will not go to you in April. It will go to whoever held the stock prior to the ex-dividend date. So it's possible to receive dividends on stocks you no longer hold because of the way our dividends are distributed. But obviously, you can see that there is a lot of opportunism. Yes. Yes, so long as you hold it before March 31st. So March 30th, the close of day comes, the close of the trading day, you can log into your trading account on March 31st and sell it. You'll still get the dividend in April. But the key is, this is where when I was young and I was trading, I tried to do this kind of stuff. I realized I was like, well, why am I going to hold this stock for 5 years? It pays a dividend. It goes ex-dividend on March 31st. I'm going to buy it on March 30th. And then I'm going to sell it the very next day. Aha. Guess what? All the Wall Street firms already beat you to it. Because what you will see typically with these stocks is that the moment they go ex-dividend, there's a huge sell-off. Like at the close of business, there are all these orders waiting to be filled of people trying to sell the stock. And it is selling approximately at a discount by the amount of the dividend. And that should make sense because when you buy the stock on March 31st, you are purchasing a stock that it owes money to somebody who is not you. And so that company is going to be worth whatever it was worth before minus that money that's about to go out. So you shouldn't pay the same price as what it was worth before. You should pay the price minus whatever dividend is about to go out. To kind of know your way around the ex-dividend date. And if you think you can get in there and get out, don't worry, people are already doing that. So it's not like a horrible strategy. Clearly people are doing it. But the thing is, you have to be the first one out. But who's going to be the first one out? Me or Morgan Stanley? Morgan Stanley is going to be the first one out. I mean, their order is very fast. They have priority. I'm sure they pay a tremendous amount of premium in order to get that priority, but they will be able to sell that stock before, that price has completely adjusted in some cases. So the efficiency of the market still holds up with respect to these dividends. But just know that in the absence of any other news about the firm, the stock should trade down that day. And so that kind of creates this day you're looking at the stock, you don't know why it's trading negatively. There's no news. You might check, well, did it go ex-dividend today? If so, you could expect the drop. Okay. So holders of record, okay, are the people that hold the security prior to the ex-dividend date. And so they're determined and they'll receive the dividend no matter what, even if they sell the stock before they receive the dividend. And then the date of payment or the date the checks are mailed. I mean, of course, these days, I don't know if any physical checks have been mailed in a long time. I think that they just send the money to your brokerage. So if you have a brokerage account, one day you might see an uptick in the cash that is in the brokerage account. And you will see that that's just the dividend. And for some brokerages, they can actually, they give you an opportunity to track the dividends. Like, hey, what are my dividend earnings for this month or this year? So let's visualize price behavior, right? So you can see here, this is precisely what I was talking about. It's just a situation of when the stock goes ex-dividend, you should expect to see a decline in the firm value by the amount of the dividend, or a decline in share value by the amount of a dividend per share. All right, that should seem pretty intuitive to you guys. Now the question is, well, does it matter? I mean, really, clearly, I think the example I just gave suggests that it does matter. It's maybe more of a rhetorical question. Of course it matters. In finance, we are concerned with rates of return. Rates of return are calculated from the prices of the stocks and the dividends of the stocks. And look, the stock price is adjusted. But I would say to you, well, think about what's in your wallet. Let's say you're not one of these guys that's jumping in and jumping out, although really there shouldn't be that much of a difference. So let's say you're a person that holds the stock long term and you're not going to do anything different. The only thing that happened in this example is you went from holding $10, let's say a Ford stock, and now you hold $9 of Ford stock and $1 of cash. What changed? If you want to, you can turn around and use that dollar to buy some more Ford stock. It's called dividend reinvestment. You can set your brokerage to automatically reinvest your dividend. And so really, from that perspective, not much has changed. Even from the perspective of the people that are jumping in and jumping out. They're jumping in right before the ex-dividend date so they can become a shareholder of record, and then they're jumping out right afterwards. What's really changed for them? Well, they bought the stock at $10. Okay, that's the only way they could have jumped in. Everybody knows the market is efficient. The dividend is coming up. Okay, then they jumped out. Now, if they're lucky, they jumped out at 9.5 instead of 9. But realistically, most of them jump out at 9. And so now they have 9. They spent $10 of cash. They held one share of Ford stock. Then they sold the share of Ford stock for $9 of cash, and they're going to get an additional $1 of cash from the dividend. It's still $10. So, but yet people are doing this. So the question might be, well, why? So one issue, like why it might not matter, is that the cash that you have in your portfolio immediately after the issuance of the dividend should be about the same, right? There should, everything that we just talked about, it's like taking money out of one pocket and putting it into the other. But I think I'll argue to you convincingly that there are some flaws with this theory. Okay, so even if the firm doesn't pay out the dividend, the expectation is that the firm will reinvest these retained earnings. Remember pecking order theory, what we talked about last class? They could just finance internal projects and make additional money with that money. On the other hand, if the money does go out to shareholders and they receive this dividend, the shareholders are expected to reinvest the money. I mean, if before you thought it was good to be invested in Ford Motor Company, okay, and now 10% of your investment has been returned to you in cash via dividend, if you like that portfolio allocation that you had before, you just reinvest it right back into Ford Motor Company. You just buy up more shares. So there is some work to be done to convince us why this does matter. Okay, so here's an example where they're going to again argue that it doesn't. Let's say a firm can either pay out dividends with one of these two plans. It can pay $10,000 per year for each of the next 2 years, or it can pay $9,000 this year and reinvest the other $1,000 into the firm and pay $11,120 next year. Investors require a 12% return, which, by the way, is the average return on the S&P 500 index for the data that we have for this course. Okay, so let's compare market values. If you have constant dividends, okay, what you have, by the way, if you're looking for where the calculation is, it's down here in the notes. All we do is just discount these dividend payments to present value. And if you discount them to present value, well, then you get $16,900.51. But the alternative payout method, because it just so happened that the firm's rate of return was 12% and investors require 12%, well, you just reinvested the money back, right? But this time it's the firm doing the reinvesting instead of the shareholders. So when you do that, right, you should get the same amount. Okay, so really, you know, everything is completely fine from the perspective of the shareholders, because they're like, well, we would have invested it by ourselves in our own portfolio at 12%. The firm decided to do it at 12%. So be it. This is fine, right? That's another demonstration of irrelevance. And in fact, sometimes low payouts or maybe even no payouts might be preferable. Because again, you know, you have to understand Facebook just now started to pay out a dividend. But I think Facebook has been a publicly traded company for at least a decade, maybe a decade and a half. So for the longest time, there was absolutely no payout. Okay. So, and yet Facebook price rose and fell, but also rose. Overall, it rose during those times. So why was Facebook valuable? Well, remember, the fact that a company doesn't pay out a dividend should not be the end of the world to a well-diversified investor who doesn't need the money immediately. If you don't need the money immediately and you've got, you know, a good salary you're living on, you live well, you're not on a fixed income, you're not a retiree, if you don't need to pay out immediately, then you have to understand that you have the claim to that money anyway. Okay, you have the claim, you just don't have the money. Your claim comes from your shares, right? You hold that percentage of Facebook, you have a claim to that percentage of its retained earnings. So if you have that claim and you're in an upper tax bracket, you might actually prefer very, very low or possibly even non-existent dividend payouts. Okay, so what that means is that if you are making a tremendous amount of money, then you are only taxed on stock when you get a dividend or when you sell. You can control when you sell, but you can't control when you get a dividend. So the board, right, when you just hold your shares and you don't sell them, you still have, you know, that claim to that prize at the end of the day, right? You still have that claim to those retained earnings. But if the firm issues you a dividend, you no longer have this theoretical claim to the dividend. It just hits your bank account and you get taxed on it. Okay, so I don't know too much about the tax framework in China, but I know that in the United States, you know, those taxes could really bite you. And so a lot of wealthy individuals would prefer to control when they take their their gains from the firm. Now, why is that? Well, I once knew and helped represent in my role as an attorney, an author. He was a fairly famous author, and he sort of had this interesting problem. And the problem he had really exemplifies why it matters that you're able to control when you can take your gains. So he would publish a book once every 2 years. It wasn't enough time for him to write a book once a year. So he would publish it once every 2 years. Now remember, you're taxed annually. So the problem was that in the year that he didn't publish it, his income was essentially zero. And so he was in a very, very low tax bracket. And so he would only be taxed 10, maybe 12%. The year that he published the book, he earned $1 million. So that year, he was in the highest tax bracket you can imagine. He was losing roughly 50% of his income. Okay, at least 50% of his income above 400,000. Okay, so 1 year he had no tax liability, basically no tax liability, and another year he had as much tax liability as you can imagine. Well, guess what? If he also had stocks, which year do you think he would want to take the gains from the stocks? Any thoughts? This might be you one day. I hope it's all of you. I mean, I don't know if I want you guys to be authors. I mean, it's up to you. But so think about that situation in your mind. Year 0, you get $0. Year 1, you get $1 million. Year 2, you get 0. Year 3, you get $1 million. Do you want to cash out your stocks in the years where you get $1 million? Or do you want to cash out your stocks in the years when you get 0? Get 0. Why? What?
So it's dividends every or
I think you have the correct answer, but what's the reasoning?
you're actually
Well, you're in a different tax bracket. That's what you have to remember. So maybe you guys are so young, you haven't had to bother with tax brackets. So maybe I should talk about them more. So tax brackets basically say in the United States, any income up to about $10,000 is completely tax-free. Okay, because of your deductions and all these other things. Income from 0 to 10,000. Let's not mess with deductions because that complicates things even further. This is not a class on tax, even though I do my taxes every year, and you bet you the deductions matter. So from 0 to about 10,000 bucks, you get taxed at 10%. Skype, I do not want to sign in. What? Man, they must really have a problem getting users to use Skype because it's like, are you sure you don't want to be signed in? We really want you here. Okay, so 0 to 10,000, it's 10%. 10,000 to, oh, I forget, maybe 40,000 is 12%. 40,000 to 85,000 is suddenly 20% or maybe 22%. And so you should be realizing what the problem is now. So why do you want to cash out your stocks in the years when you have 0 other income?
yeah.
Right. I think your intuition is correct that you already earned $1 million that year. Everything, this is why your marginal tax rate matters. Everything after 400,000, you lose half of it to the government. So if you cash out that year, 50% of all your capital gains are going to be gone to the government. On the other hand, if you wait and you cash out in the year where you have low income, then you're able to mitigate the impact of the taxes. Maybe you only make it to the 25% tax rate instead of the 40 or 50% tax rate. So when you think about it that way, you can see why dividends might be annoying to a wealthy person, because you can't stop the dividend. You have to pay taxes on it whenever it comes in. So if you're this guy and you have 0 in year 0, $1 million in year 1, 0 in year 2, $1 million in year 3, right? You are toast on all the dividends that come in year 1 and in year 3, because in year 1 and year 3, I'm sorry, in year 0 and year 2, right? So whenever you receive your million, all the dividends that come in that year, you lose like 50% of them. So that's really tough. That's unfortunate. And obviously each country differs with respect to its tax scheme, but yeah, like that money is going to be gone and it's irretrievable. So no matter how you play it, you're going to lose that money. And that's why you would prefer to have a low dividend payout, because then you 100% control when you take your gains. Skype, I'm going to uninstall this app. It's doing this every 5 minutes. Okay, now what about high payouts? Okay, well, let's say you're retirees. Okay, and so if you're a retiree, then you're going to have this issue where you don't have salary income. And for a lot of people, it gets kind of scary when you don't have a salary income. And so you want a stock that pays dividends consistently. Okay, so when you have a stock that pays dividends consistently, it's basically like getting a salary or a pension, right? It's just something that comes in every 3 months, let's say. And so that's why you see stocks that pay dividends consistently be very favored by people who are retirees. You know, it used to be like AT&T, which is a phone company, although now it's more like an internet company. You know, that used to be a big favorite because it used to pay this very consistent 5% per year dividend. And retirees like that because that's considered a pretty high dividend with fairly mitigated risk. So telecom companies, utilities, companies like that, where nothing terribly exciting happens, but they sort of provide a steady stream of dividends for their, you know, the owners of the stock, those can be preferred for them. See, they don't have, many retirees don't have this problem of, I'm making $1 million every other year. They wish they had that problem. For them, it's like, well, I'm just trying to live happily the rest of my years and so on. Okay. So there's something to be said for that. There's also the idea that you want to resolve certainty. Yes, as a shareholder, you have a claim to all of these shares of stock that entitle you to a portion of the dividend that the company issues every quarter or every year. But it's possible for management to screw up in the future, right? And so maybe you don't trust them, and you don't trust the CEO. You know, maybe it's Elon Musk and he's just too eccentric or something like that. You want to go ahead and get your money periodically, and then if you trust how the company is doing that quarter, you can reinvest back in the company. And if you don't trust how the company is doing that quarter, you can go out and you can buy another company with the dividend. Now, of course, somebody could say, well, if you don't trust the company, just reduce your stake in the company by selling shares and buying another company. But again, doing that will have some additional tax consequences. Okay. Now, the good thing for some investors is some investors can be tax exempt. And then there's also some dividend exclusions for corporations that own stocks. And you should also know something that is not mentioned in these slides, I believe, but it's called a qualified dividend. And it basically tries to address the problem I brought up by saying that if you hold a stock a certain amount of time, and it has to be a qualified stock, hence a qualified dividend, if you hold a stock for a certain amount of time, then it's sort of like a long-term capital gains rate is lower than the short-term capital gains tax rate. Well, it's the same way here. So if you hold this qualified stock for 90 days or more, and then every dividend after those 90 days comes in at a reduced tax rate, basically a long-term capital gains tax rate. So again, not tax-free for most people, but they sort of do try to incentivize you to hold the stock long-term. The government does. The government thinks holding stocks long-term is good. I'm not sure that's true, but that's the folks that write the tax code. And so, you know, even though I might not agree with the rules of the tax code, it's important to know what those rules are and try to follow them. All right. So dividends can also be signals. Okay. So you saw Facebook had this massive jump the day it declared its first dividend. Okay. So like a 10% jump in one day for Meta. And the reason for that is that people believe that sometimes this is a signal from the company. Just by definition, even though like I'm a shareholder of a bunch of corporations, but I don't really know what's going on inside those corporations. I don't know things as well as the manager or the CEO of those corporations does. So this is known as asymmetric information. It just means that the information he has is different than the information I have, and his information is better. But he is making the decision about dividends in conjunction with the board, who, by the way, also knows some things that I do not know. So since you've got these dividends that are declared, right, the declaration of these dividends is said to contain some information about the firm. Okay. So let's say that a dividend increases. Okay. And I'm talking about the regular dividend, or perhaps in some cases, the extra dividend, right? So that can be a signal that management believes in the future this dividend can be sustained, right? We're not just jumping up and jumping back down. We jumped up to 20 cents a share. Now we're back down to 10 cents, which we always paid before. No. The idea is that if you jump from 10 cents a share to 20 cents a share, or from 0 to whatever Facebook's dividend is now, you believe that that is sustainable. Okay. So that's obviously important. The idea is that now we expect higher future dividends. Well, you remember how we valued stocks, right? It's just discounted value of all future dividends. Well, now we think future dividends are going to be higher, so the value of the stock should rise. The idea is generally that this means it's a healthy and growing firm. Again, you don't really have to trust that. I mean, there are clear exceptions, but that's the idea. Now, what happens if the dividend decreases? Okay, basically it means that prior dividends are unsustainable, that there are lower dividends that could be the case indefinitely, which again, you're now discounting a smaller value to present value, which means that the overall value of the stock, the present value of that security should fall. And that's a signal of financial difficulties. Now, not always. We can think of other situations where firms say, look, we just have so many great internal ideas that instead of issuing this money back out to shareholders, we're going to internally financing these ideas via the pecking order theory. But this is not always how it is perceived. Usually, I've certainly owned stocks that have increased dividends. Their prices tend to go up. When they decrease dividends, prices tend to go down. Okay, so even though the firm might argue the other side of it, that, hey, we don't need a high dividend, we just have some really great ideas, the market doesn't seem to always buy that argument. Now, your dividend theory is going to alter who buys your stocks. Remember, I talked about wealthy people that have high yearly income some years and not other years, or might be seeking other tax shelters. They usually prefer firms that don't have large dividends. On the other hand, let's say you have retirees, they want large, consistent dividends. So it's possible that depending on your choice of dividend structure, you can sort of pick your shareholders, right? If you choose to have no dividends or very low dividends, you're going to be generally a firm that is owned by very, very wealthy individuals. Whereas if you're, let's say, a utility company, there still may be some wealthy owners. There almost always tends to be, but you're also going to have some retirees that participate in firm ownership. And just remember, those people have power. They have voting power over, let's say, decisions about the board and who serves on the board, as well as shareholder proposals and the results of votes of the shareholder proposals at shareholder meetings. So basically, you can kind of juggle around your shareholders by changing your dividend policy, right? You can sort of attract different owners to the firm if you're the CEO. And there's some question to how frequently CEOs actually do this, or boards actually do this, because in a way, again, the CEO is not elected directly by the shareholders, but the board members are. And so it's possible for them, kind of like it's a political process, right? And in politics, politicians pander to the voters. And if you're board members, you can pander to the shareholders. So, I don't know to what extent there's a whole lot of clientele selection going on, but clearly there's the potential for some. All right. Now, you might have heard that these days on Wall Street, the hot new thing is not to issue dividends. It's to repurchase stock shares. Now, you can understand, I hope, at this point, why a stock share repurchase is basically like a dividend when it comes to the transfer of value to the investor. Okay, so let's say that Tesla has 1 million shares and is worth $1 trillion. Okay, it has a lot more shares in reality, but let's just say. So it's got 1 million shares, and it says we're going to repurchase the shares. All of a sudden, right, if the stock is repurchased, the number of shares outstanding will decline. The firm value, let's say it remains at $1 trillion, but the number of shares drops from 1 million to 500,000. Okay, now the value of each share has risen. It's sort of like the opposite of inflation. If you print more dollars, each dollar is going to be worth less. If you have fewer dollars, each dollar is going to be worth more. Well, it's the same way with shares of stock, right? This is an example of company just saying, we will buy back these shares, and by buying them back, we're going to increase the value of each share that our current shareholders hold. Okay, and so by doing that, they're essentially saying this is a dividend without paying a dividend, right? Because now the share value has increased, and you can take that gain right now if you want to by selling the share that now costs more on the open market. Or if it is not the best time to take a capital gain right now, you can just hold on to that share and know, yeah, this is great. The value of the share rose. And by holding on to that share, you both are wealthier in terms of measuring your net worth, but also you get to take that gain whenever it is most convenient, if it is ever convenient for you to take that gain. Okay. So when a company buys back its own shares of stock, what it can do is it can make a tender offer. All right, so it just says, hey, we're buying this stock back at this price. And then people will usually sell the stock at that price. It's usually a slightly higher price than what the market is offering. Or you can just go onto the open market and snatch up shares. Okay, because you can always find, almost for any stock, you can almost always find some ask orders, right? So these are orders that haven't cleared yet. Nobody has jumped up and bid that price. Well, the company can jump up and bid that price and then clear through those ask orders. So again, it returns cash from the firm to the shareholders, but indirectly. It does so through the increase in share value. Okay, so again, this is an argument that maybe dividend policy is irrelevant because we can just make this kind of return of shareholder value to shareholders by spending retained earnings on, or not retained earnings, but spending the income that the firm makes to repurchase shares rather than retaining that money in earnings. But again, if you're a retiree and you don't like to move around your portfolio very often, you don't like to actually sell your shares, you just like to receive a dividend, that may not be so appealing to you. So stock repurchases allow investors to decide rather than having the company decide for investors. So repurchases seem more desirable, and the IRS actually has some limits, although I don't know how good they are at enforcing them. In theory, the IRS says you shouldn't just do repurchases in order to, allow investors to avoid taxes, right? IRS always wants to collect as many taxes as possible, but it's very hard to prove that intent in reality. And, the companies can always say, well, we're just trying to restructure, our capital structure. You've heard the arguments. So what do stock repurchases tell us about the firm? Well, generally it means that this is a positive signal. After all, if I'm a manager and I see a bunch of my company's stocks trading out there and it's really expensive, right? I would not repurchase those shares because it's like, look, the market is pricing my company at $100 a share, but I know we're only worth 80. Why am I going to jump in there and spend company cash to get the company shares at a higher price than they deserve to be? I'm the manager. I mean, who in the world would know the value of the company better than the manager? So generally, when managers do buy back the stock, the company is seen to be signaling, the insiders in the company seem to be signaling to the market, you know what? You guys are underpricing us. In fact, if you're going to underprice us that much, we're going to go out and enter the market and actually snatch up some shares. Okay. So tender offers send a more positive signal. Okay. Because the company is stating a specific price, which again is usually higher than the price being offered by the market. If it was lower, then nobody would ever opt into the offer. But they give you a higher price. So an announcement of a stock repurchase that increases prices. Okay. All right. Repurchase announcement. I mean, you guys are free to kind of like read this on your own. And, this is, I forget if this is real, but this is an example of one. I believe it must be real. So anyway, this is this is what it looks like. If you're on the Bloomberg terminal or somewhere else and you're looking through your news, this thing could come up and it'll just say, so, American West Airlines announces this buyback. And then you would click on the story and this is what you would see. Now you can say to yourself, well, does this persuade me the company is doing good? I don't know if you gather too much from the text that would be sort of like, yes, we're doing better than the market knows. But the signal itself that you're engaging in the repurchase is what gets you there. So when it comes to like what we actually observe, I mean, these are all theories of why dividends may or may not matter, but also what we care about with respect to these theories is what do we actually observe in the real world? Because if you recall your classes in microeconomics, you should recall that depending on what assumptions I make about the model, my outcomes can be very different, right? And so we need a way to break the tie because just rationally, like within your own mind, there could be multiple good models that yield very different outcomes. So the question is, well, what does reality tell us? Like how do these things ultimately end up? So what we know is the corporations tend to smooth dividends, meaning that even though things like net income move quite a bit, like there's quite a bit of volatility in companies' net incomes, dividends don't move as much. Okay. So the idea is that, CEOs try to keep, shareholders not, how would I put this? They try to keep them calm. Shareholders don't like to face risk in estimating their future quarterly cash flows from this company. Nobody likes a company that's zero dividend this quarter, $10 next quarter, $15 the quarter after that. That presents within it the kind of risk that we talk about when we talk about the risks associated with the funds in Chapter 12, right? The way we measure the risk of the S&P 500 or of small cap stocks or of bonds is the variance in their prices, right? And the standard deviation of their returns. Well, if you have a tremendous amount of shifts in dividends, right, you suddenly have introduced a larger variance in returns with respect to the stock's dividend payouts. And you typically don't want to do that. So dividends do provide information to the market. Like I said, you do see the prices of stocks moving around. And, I know that is frustrating, right? I mean, isn't it frustrating to have your dividends move up and down? What would be one of the reasons? I'm asking you, a young lady with a hurt knee, maybe. Why don't you tell us why shifts in dividend payout policy really frustrate you? Don't you think they make stocks riskier and, obviously alter the stability of your cash flows as the investor? Oh, that's okay. All right. Well, I'll repeat. So you don't have to necessarily answer this, but just kind of pay attention. The idea is if there are great changes in dividends from $0 to $15 back to zero, all of a sudden you're introducing tremendous amount of variance into the dividend yield, right? And when you introduce a variance into the dividend yield, we saw how investors respond to variance. They generally see, volatility and variance in returns as something that would require a higher return from the firm. So if you're a firm and you have all these inconsistent dividend yields, okay, you're actually going to have to return more in order for investors to purchase your stock. And if you don't return more, your stock price will fall. And then you're the CEO who's likely compensated in part based on the stock price. And so you don't want that because now your compensation has fallen. Now, ideally, what this dividend smoothing should not do is it shouldn't force you to ignore NPV positive projects. Whether it does or not is sort of an empirical question. But if the NPV of a project is positive and you have to alter your dividend, I guess the theory generally is you should alter your dividend, even though it'll create some variance in the dividends. But you should go ahead and find that money to accept that NPV positive project. Okay. So if there are no better uses for the cash, you should also consider your clientele. Who are your shareholders that you're supposed to serve? And so when you serve your shareholders, you'll be able to, get reelected if you're the board member, and also if you're the CEO, because ultimately the board members are elected frequently to either maintain or change current firm leadership. All right. So if you recall, like to kind of sum up, payouts are massive and have increased over time. Dividends are usually concentrated along a small number of firms. Managers don't like to cut dividends and prefer to smooth them if at all possible, because cut dividends send a strong negative signal to the market. Raised dividends usually send a positive signal, but from what I recall, it's not as definitive. And then, unanticipated changes in dividends, right around the declaration date of those changes, the markets react, and the market reaction is frequently reflected in the price, and ultimately both in the dividend yield of the firm and also the overall return and yield that the stock gives you. Now, we can survey the managers. Now, here's the thing about surveying. There's nothing where we can make the managers answer. So this is just the managers that did answer. Now, later on, I just want you to understand that anytime you have that, these seem persuasive until you start thinking of, well, why didn't some managers answer, right? Isn't that selection bias? Like maybe the people that are answering this poll have time to answer the email. I don't know if we have Elon Musk in this poll. I don't know if we have Zuckerberg. Like it's kind of ironic, but I mean, the polls are fun, but if the managers that are really the best managers, they're not being paid for this poll. So the best managers would send this poll to junk mail and never answer it. And so your answers would only come from the managers that are so, they're like, oh, I guess I'll answer this poll. I'm not doing anything else. I'm receiving a salary, but not working for it, right? How well is my firm run really? So let's see what they say. So the ones that answered, almost all of them try to avoid reducing dividends per share. They try to maintain a smooth dividend from year to year. So if they have to reduce, they want to reduce to a number that they'll be able to maintain in the future. Now only 41.7%, they use their dividend policy to attract particular type of investors. It's actually remarkable that they admit that. I mean, it's like, wait a minute, you're the manager, okay? You're supposed to work for me, the shareholder. Your job should not be, let's adopt whatever dividend policy will be to get rid of this shareholder I don't like, so you'll sell my shares and I'll get a shareholder that I like better. And I don't know how I feel that almost half of these managers are trying to pick their shareholders. It's like, no, the shareholder is supposed to ultimately pick the manager through the board, not the other way around. But nevertheless, these people, the folks that answered, openly said this. Okay, now they say that maintaining consistency with historical dividend policy is important. Stability of future earnings is important. And then 9.3% say flotation costs to issue new equity are a consideration. That's a small number, so almost none of them actually consider it. Just goes to show you flotation costs are there, but to most firms, they're not that much. But I just want to point something out to you. 93.8 or Skype. Okay, I have to minimize this maybe. All right. This is an advertisement for Skype lecture. Actually, it's a disadvertisement for Skype for constantly popping up throughout my lecture, even though it is closed. So think about what could happen in terms of selection bias here. Let's say that the people that answered this poll are all people that work at companies that don't require a lot of involvement. They're all utility companies, yeah, we provide water, electricity. It's the same old, nothing new, right? So maybe the CEOs that answered this poll are the CEOs that sort of enjoy the quiet life. There's a very famous paper, by the way, with nearly 10,000 citations called Enjoying the Quiet Life. And so the hypothesis of that paper is that managers, CEOs, when they get in that position, they're getting such a good compensation package, it's the most money they will ever make in their lives, that they don't want to rock the boat, right? They just want to sit there quietly, forget about me, forget about the firm, right? Here's your dividend, shareholder. We're just going to keep it slow and steady and enjoy the quiet life, right? And so that paper actually talks about productions in factories, but the same can be true with dividend policies. And maybe the managers that enjoy the quiet life are the managers that have time to answer this survey. And the point of the Quiet Life paper was that those managers actually are not producing quite as much as they could if they did not enjoy the quiet life so much. So going back here, right, let's say Mark Zuckerberg, who this textbook was written in 2019. As of 2019, Mark Zuckerberg had never issued a dividend. Let's say he was there. Let's say the CEO of Microsoft was there. There was like a 10 or 20-year period where Microsoft did not issue a dividend. Let's say Tim Cook of Apple was there back when Apple was not issuing a dividend. Let's say all those guys were there. Think about how much this might change. Because, what's his name? Zuckerberg might say, well, I'm not at all worried about maintaining a smooth dividend, unless you call a smooth dividend zero, in which case, yeah, I'll maintain that because I have so many good internal projects I want to invest in, right? But the thing is, Zuckerberg is probably really busy. And so he wouldn't answer this poll. Musk wouldn't answer this poll probably. Moreover, this is how selection bias works. Think about the value of the firms, right, that are involved in this poll. I bet you there are CEOs of 10, 20, $30 million companies. A bunch of them answered this poll. But the poll is not weighted by the strength of the company. And it's kind of ironic because the bigger your company is, the more influential your company is, the more we care about your company's shares, the less likely you have time to answer this poll. Again, who is it that owns companies that are worth trillions of dollars? It's not people that have time to respond to these polls. And of course, as scholars, we don't actually have the right amount. Like, you'd have to pay, Zuckerberg, maybe, I don't know, $100 million so he would take this poll, because otherwise it's not worth his time. Maybe 10 million. I don't know how long this poll was. So, when you're dealing with really, really, really highly accomplished people, it's actually really hard to get their input, because a lot of them, it's like, if you're Jeff Bezos and you're earning, I don't know how much per minute, probably like, I don't know, $1 million. And if you're earning $1 million per minute and somebody comes to you with this poll, it's just like, why am I going to take any amount of time to do this? And I'm going to go out and either run my firm or have fun. I mean, this is neither. Now, also be aware that there are stock dividends, which is sort of like, in a way, it's the opposite of share repurchases. You're actually issuing shares to individuals who are current shareholders. But the idea is that while you are issuing shares, the value of the shares that are held by everybody all across the markets, you're issuing the share, having the shares is still better in terms of price than not having the shares. And so they issue these additional shares, right? There are small and large stock dividends. Small stock dividends just means that it's less than 20 to 25% of shares, right? So if you own 100 shares and the company declares a 10% dividend, then what do you get? You get 10 shares, because 100 times 10% is 10. Large stock dividends are going to be larger, obviously 20 to 25 percentage points of the firm or more. And yes, they have this dilution effect, but the general sense is, well, it's better to receive some stock. And in case the firm issues cash dividends in the future, because that's, at the end of the day, you want cash, right? Having these additional shares will entitle me to more of that cash dividend than not having these shares. So, one can debate the efficacy of issuing stock dividends, because it's just issuing more stock. What's the stock worth, right? Well, now it's worth a little bit less because you're just divvying the same pie into more and more shares. But, maybe it's better than nothing. Some people do it. Now, you also have stock splits and reverse stock splits. This is not really a dividend in the same sense. Just sometimes, for whatever reason, people see the price of their stock and they say maybe it's like prohibitive. Like, let's say your stock, it became like Berkshire Hathaway. One share of Berkshire Hathaway, I think, is like $500,000. One share. Now, for you and me, well, I don't know how wealthy you guys are, but it's tough to lay out, just psychologically, it's tough to lay out $500,000 for one itty bitty share of a stock. And so what you could do with Berkshire Hathaway is you could say, let's have a stock split. Okay, let's say for every one share you hold, I will issue you 100 shares. Okay, then that will lower the price, or not 100, 1,000 shares. So that 1 to 1,000 stock split would lower the price from $500,000 a share to $500 a share. And then small investors who may only be able to come up with $500 are now able to invest in the stock, where before they had to go and do this weird thing where you get partial shares, and there's some question as to who owns that little bitty share, portion of a share. Those things do exist. Just be aware of the fact that they do. But just know that you can split the price of your stock so that, it's a little bit less ridiculous. Now, Warren Buffett, who is much wealthier and wiser than me, has chosen not to do that. Maybe he is also picking his investors. He doesn't maybe want people who can't afford $500,000 per share. Maybe he only wants really wealthy people to invest in his firm. And so he has chosen not to stock split. You can also do a reverse stock split. And I'm sad to say that I've been an owner, I've been an owner of stocks that have split and have reverse split. And when I was an owner of stocks that split, everything was fine. They just split and they were worth less. But when you do a reverse stock split, usually it means your price has fallen so low, it looks ridiculous. So what you do is you go the other way. Let's say your price went from being $1 to being 1 cent. 1 cent, there are stocks that are worth only 1 cent. Well, that kind of looks ridiculous, right? You're basically listed as you are listed as a penny stock. You might get delisted from the stock exchange. What if your stock drops 10%? It's 1 penny. Now it's whatever 90% of 1 penny is. We don't even have a coin for that. So things look ridiculous. So then you do a reverse stock split. So you say, okay, I'm worth 1 cent a share. We're going to give you 1 share of stock for every 100. Okay. So then you have gone the other way and you are now able to say, well, before we were worth 1 cent per share. Now we're worth $1 per share because the number of shares outstanding for our firm has been reduced by 100. Okay, so that's why you do stock splits, but they're listed here because these are sort of interesting to issue or similar to issuing a stock dividends. Okay, quick quiz. You can take this yourself. Also, try out this comprehensive problem. Okay, here's the solution. So just make sure to prepare it. I want to take this time to address that question I pointed out during the last exam. So I checked, and that question about the auction, the Dutch auction, it's just wrong. I've read it. I can't read it any other way. So what I've done is I've gone back. Before I said I'm just going to remove the question. But then it makes everybody's grade out of 99 instead of out of 100. Maybe that's undesirable. So what I've done instead is I just went back in all of your grade books and gave you a point for that question. So if you got it right, your grade is the same as it was before. If you got it wrong, I went back and made it to where you got it right. Okay, so you have any questions about that, or you want me to explain why that Dutch auction question was wrong? I'm happy to do it, but there's just no way around it. That the way a Dutch auction is supposed to work is that you start with the top price and the number of shares that is offered to purchase. And if that's enough, right, that's your purchase right there. If not, you go to the next bid, the number, and the number of shares. If those two bids together are enough, then you stop there and you use the lower of those two prices. If that's not enough, you go to the third bid and the third number of shares. You keep going down until from the highest price down, until all of the shares that you're trying to sell would be sold at a low enough price. And once you find that price becomes a price for everybody that bid at that price or higher. Okay. And I believe if there is a tie for who should get the shares, right? So is it the highest? Like, let's say that the number of shares being auctioned is smaller than the total number of shares bid for by those three prices. Then there is who gets those shares that are going to be partitioned. That person is going to be the highest bidder. Okay, so when it comes to breaking ties, whoever bid higher, that guy is going to get the shares. But overall, when you're looking at the price that the company sold the shares for and how much the company was able to raise for that firm, or for that stock sale, you have got to use the price, the lowest price at which all of the shares are sold if you start at the top, right? So top price, if it doesn't sell everything, go to the next highest price. That price doesn't sell everything, go to the next highest price. If at that price, all of the shares would be spoken for, okay, then you use that price at which all of the shares would be spoken for and multiply by the number of shares that the firm is trying to sell. And that's how much the firm gets. Among the bidders, you first make sure that the highest bidders are satisfied, and then you get down to the person that bid the price that ended up being the lowest out of the high prices and was ultimately applied to all of the shares that were sold at that auction. And then that person, if he bid for more shares than are left available, that person just gets whatever the leftovers are, receives the remainder of the shares and pays the price that he or she bid. So there's just no way to spin that question any other way. It should have been phrased different. It wasn't. So I'm just going to give everybody points for it. Hopefully you didn't spend a tremendous amount of time thinking about it and just moved on to the next question. All right. Questions, comments, testimonies. All right. Remember, bring your flash drives next class. And then let me stop the recording. Oh, thanks, Skype. Skype is back. All right.